Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani, but you knew that. Investors are in love with their 4% plus bond yields, but is that a thing of the past? Will investors flee to stocks as yields drop? Let's talk with two big bond ETF authorities. Joanna Gallegos is co-founder of ETF firm Bond Blocks. Jerome Schneider is PIMCO Managing Director and Manager of the PIMCO Active Bond ETF, that's BOND. Joanna, I know we were talking before, you're telling clients they should increase their allocation in fixed income. Why, and what specific areas of fixed income do you like now?
Well, I think fixed income is very different today than it was 2 years ago at the beginning of all this volatility. First of all, we are nearing the end. We all probably agree we're at the end of the great rate hike. So rates are high, and that makes a lot of difference in a portfolio today than it did when we started out with rates being almost at zero. So it can be really important to start looking at fixed income as you diversify and you manage more risk.
So tell me a little bit about what you like, though. You were mentioning moving out on the yield curve as well. Give me some examples of ETFs that you sponsor that you like.
At Bond Blocks, we are about precision and being able to pick your spots in this opportunity set in fixed income. And so one of the intuitive things that we were talking about as we came into the show was, as you're moving out of cash and you're looking for the next opportunity, a very simple thing to do if you're not ready to take on any credit risk of the corporations is you can move out in duration. You can move very simply out into the 2-year, 3-year, 5-year. You're not going all the way to the 10 and 20-year, which we saw last year. When you get that trade wrong, it can be very volatile, and it has been volatile this year. At Bond Blocks, we were talking this morning that, I think the 20-year was down 10% at one point this year, and now it's up 4%. So something in the middle of the curve might be a great next step.
So on treasuries as well as corporates here. So I see you have the 5 to 10-year triple B corporate bond, that's BBBI. So you're right in the middle of the yield curve there with the Treasury, XFIV, and the BBBI, right?
Yeah, and so the triple BI, what's interesting to talk about there is, when people think about high quality credit, they think about investment grade. And so their first thought is sort of in the A rating category, AAA, single A, double A. And what they don't probably realize is there's an immense yield pickup as you move to a triple B. So triple B is still investment grade. It has a very low, if any, default rate risk at all. And you're picking up, I think I checked just a minute ago in the intermediate product, triple BI, you're picking up an extra 80 to 90 basis points in yield. Just by going up a small, going into triple Bs a little bit, you're still getting investment grade, you're still getting really great quality.
Jerome, you manage one of the largest actively managed bond funds, bond ETFs in the world, PIMCO Active Bond ETF. BOND is the symbol, folks. How much will the Fed cut in September? Let's get that on the table. And what are you doing now in that actively managed fund?
The Fed would like to cut about 25 basis points or so, just simply because they're focused on being sufficiently confident in that inflation beginning to ebb back to more normalized levels. But the growth prospects, and there's a lot of data, Bob, between now and September, but the growth aspects is really what the market is going to be very focused on, which is why we're sort of perceiving at this point in time, the market is perceiving a potential for a 50 basis point or even some intermediate cut before the next meeting in September. And while that's not our baseline prognostication here at PIMCO, we do recognize that this is the beginning of the easing cycle, and we have to rationalize what that means for fixed income investors more generally. Number one, that cash rates, those in money market funds, are going to see their yields ebb as soon as the Fed begins to cut that rate, and it could be pretty quickly. Secondly, we also see the value of owning a little bit of interest rate exposure. Again, favoring the front part of the yield curve is a place that we think is most attractive at this point in time. In the 2, 3, 5-year spaces, there's plenty of opportunities across diversified portfolios to look. And so as we continue this rate cutting sequence, the precision of what the actual rate cutting sequence has isn't necessarily as powerful as having a diversified approach which offers additional high quality spread and income along the way. And I think that the main takeaway for investors is that they're entering these market conditions with a generally underweight posture to fixed income. Recognize that there's a lot of different avenues to participate in fixed income, and that takes an active hand in that. And at the same time, while guessing what the market is going to do in terms of yields or the Federal Reserve is going to do in terms of rate cuts might be something that people would like to do, what we're seeing here is that there are better risk-adjusted returns by being in an actively managed fixed income diversified portfolio than there have been in many years. And that's where the invitation is wide open still, even as rates have begun to rally, for investors to begin to take advantage of those quite attractive total returns at a lower volatility point.
It's still amazing to me. 1 month, 5.3%, 10 years below, 4% now here. Same question for you. There are expectations the Fed could cut 50 basis points in September. I know you're not an economist, but will they do that, or what are you telling clients, or will they be more measured?
Yeah, I think the Bond Block's view is that the Fed will be more measured. We are not calling, and we don't see a 50 basis point reduction in September. We think that given the economic data from last week and where we're at today, that it is pretty certain that maybe a 25 basis point cut would likely happen in September, and that's where we stand. We think that we need more time and more data to iron out where we're at.
Yeah, is the yield game over at this point? I mean, if those people, the viewers, I can tell you, I get emails. They love this 4%. Anything over 4%, they perceive a positive real yield, inflation adjusted yield. Can you still get north of 4% and stay on the higher quality end of the bond spectrum?
Yeah, you're definitely. I mean, I think it's now more than ever to take a look at the different opportunities in fixed income. You have to be able to see them, and so we launch products that you can see lots of different cuts of treasury yields, lots of different cuts of the way credit is yielding across investment grade and high yield. So we look at this all the time. We can't stop focusing on yields north of 5% are in investment grade, and even further into high yield. Now, it may not be your cup of tea today to talk about high yield, but the truth is that we still, and we're hearing a lot of commentary today, that fundamentals still look strong for corporations. And especially in the higher quality cuts of investment grade, and even in some of the higher quality cuts of high yield, there's opportunity north of 5, 6, and all the way down the rate spectrum down to 12.
Yeah, so. But Jerome, she brought up high yield. Give us your thoughts on this. I mean, obviously, there's a risk here, a default risk that's very real if the economy slows down. Where do you come down on the high yield side?
Yeah, we're beginning to see the need for differentiation, how market risk is being assessed, is being implemented, and ultimately tolerated. And part of that is to understand the profiles of the underlying credits. First and foremost, let's be clear, this is an environment where having resources, both in terms of the understanding of how a corporate balance sheet is going to evolve in tighter liquidity conditions, is going to be important. And having differentiation across the sectors, whether it's high yield, investment grade, asset-backed securities, is going to be incredibly important. So actively navigating these landscapes and just sort of honing in on a yield and a specific sector because of that isn't necessarily the right ingredients for success. Instead, we say that there are probably components of high yield, and admittedly today, or over the past few days, the lower rates we've seen have actually probably benefited some of those high yield issuers from coming back to market who have tighter liquidity conditions. But it's also a sensitive that we have an outlook right now, and the market is clearly embracing this, that growth is beginning to be a concern. And if that sort of metastasizes over the next quarter, 2 quarters, 3 quarters, you might want to be a little bit less credit sensitive in the corporate sectors at this point in time. Which is why at PIMCO, we're sort of looking at the environment, looking at the landscape, and diversifying into higher quality sectors, agency mortgages, asset-backed securities, things that are more insular in those left tail, risk off, and lower growth enviiroments, so that the susceptibility to portfolios.
You don't have a lot of high yield in the BOND fund, I gather.
Correct. That and even in our more income-oriented strategies like a PYLD, we're sort of thinking about it as an element, but not necessarily an emphasis. And that's where we're focusing on the diversification aspects of being in the markets right now. But it does get you to the point, Bob, of having a 4+% type of distribution yield, of yield to maturity, plus some total return potential, which is ultimately the other side of the coin, where investors are going to see that their total returns and their risk-adjusted total returns are what people are really going to focus on as rates become down, and if volatility remains, at the forefront of people's minds.
Yeah, risk-adjusted return becomes very important in a slowing economy when you're dealing with high yield. I found that out the hard way. I want to go back to money market funds because people love these money market funds. $6 trillion in money market funds, astonishingly sticky money that's there. Is that money going to stay there now that yields are lower? Will any of it find its way into the stock market? And I want to get Jerome's opinion too on this.
Yeah, I think cash has been sticky for over a decade and been on the sidelines. And so we've seen different ways that clients have moved out of, or moved a little bit out further from cash. Maybe they've gone into a short-term duration ETF, or they have done things like gone into the treasury trade in the last 2 or 3 years. So I think that balance has always been very hard to crack, for sure. But I think the important thing is that you can still trade in and out of that when you want to. And I think the ETF is a really important solution for treasury exposure these days, so that you're not sort of locked into either a CD or a money market fund that's frankly probably a little overpriced. And there's a lot more price efficiency in treasury bond ETFs. These days you can
tell
trade
it
it
to
for
our
3
viewers,
basis points.
they get 5% in some of these money market funds in their retirement accounts.
Yeah.
You know, like Vanguard, and it's quite amazing that and they love it. They sit there and they don't worry that much.
I think there's a danger in that because they're not looking at what that product is, how much it's charging them. So if you're getting 5% yield but you're being charged 40 basis points for it, that's not okay in this market, because there's a lot of yield to be had in the treasury side and still in the short-term side, and you shouldn't overpay for your cash exposure. I think that's something that they should take away.
Jerome, you were making the point earlier about these money market funds that the amount of money that would probably find its way into the stock market from here is fairly small. But give us your thoughts on how sticky that money is in money markets.
Yeah, we've done a few different points of analysis here at PIMCO, and the first one is that when you think about the $6.5 trillion sitting on the sidelines in money market funds, it's not all meant to be put to work in terms of risk appetite. It's probably something around 15% by our assessment, which is a huge amount of money. You know, $600 to $800 billion. But at the same time, we aren't finding that it's going to be put to work on a dime. Days like today might incentivize people to put money to work in risk, but not necessarily motivate people to do that. At the same time, what we're also saying is that there's structural reasons why money market fund yields will come down. Obviously, benchmark rates moving down by Federal Reserve easing is the main culprit at this point in time. And if you forecast that we're going to have 5 or 6 rate cuts, you know, on the near-term horizon, as the market is suggesting, getting closer to that neutral rate of 3%, you're finding yourself moving from a 5% risk-free rate to a 3.5% risk-free rate pretty quickly on that cash. So how do you balance that? You move to those ultra-short ETF strategies, low-duration ETF strategies, even the bond and core-like ETF strategies that have actively managed components. And in doing so, you find yourself in a healthy way to earn structural premium, earn risk-adjusted returns based on spread products which are more attractive, and at the same time complement the market as it continues to evolve toward perhaps a lower growth environment than we witnessed earlier this year, and an inflationary outlook which might be somewhat lower than what we've encountered over the past few years. So having the resources to navigate this landscape is incredibly important. And most importantly, diversification. We think that this environment is a requirement for diversification across asset classes. And so when you look at our complex at PIMCO, generally speaking, our strategies are leaning on that diversified approach across some corporate exposure, asset-backed securities, other high-quality assets, including agency mortgages. And that's incredibly important as we begin to navigate the different opportunity sets that changing liquidity fundamentals bring to the market. And that's where the value ends up being revealed.
So, Jerome, just a quick follow-up. A good part of the bond portfolio, BOND, the ETF portfolio you have, is mortgage-backed securities. Mortgage rates have come down over the last few days. I think we're looking at 6.4% mortgage rates now. For people looking for a home, where are mortgage rates going? Can you prognosticate on that? And where does mortgage-backed securities fit in with a bond portfolio?
Well, everybody would like mortgage rates to come down, and we think that mortgage rates will come down as obviously the spreads will tighten from the origination's point of view. More practically speaking for investors, the way we think about agency mortgages is a treasury surrogate, a high quality surrogate, plus some spread. And while the environment has fundamentally changed over the past year as regional banks have taken a step back from the amount of agency mortgages they're buying, we think it's a great opportunity to use it as a diversifier for our higher quality fixed income ETF portfolio. So for bonds specifically, it's been a growing part of that fundamental approach. And what might change is a technical factor about which coupon we buy, things like that. But as a baseline asset class, we think it's a great asset class and a diversifier given the spread components and the quality, nature, and liquidity of it versus the rest of the market opportunities that we see at this point in time.
Do you, Joanna, you want to take a crack at this mortgage-backed securities? Any thoughts on mortgages, Brian?
No, I think there's a good point about investing in a multi-sector asset actively managed fund. We have an active fund that does just that. But what it does is it takes a spin on right now. You need someone to help you understand the relative opportunities amongst these sectors. So we violently agree with that. Our multi-sector product is called TAX, T-A-X-X, and it has two dimensions to it. One, it's optimizing for your after-tax experience. And sometimes in markets like this, and this is where it'll be interesting to talk about more, is that sometimes it's better if you are in investment grade securities, or you're adding mortgage backs or non-government securities, and or munis. And so I think Jerome's right. There's ways that professional active managers can help you navigate these opportunities, which aren't as easy to see if you don't have the perspective.
But you seem to be talking both sides here. I mean, I'm a Jack Bogle guy, so Bogle would have argued you should own a broad, diversified bond portfolio. There's a reason AGG is such a diversified fund, and yet we sort of talk like market timing works. Like we're going to get out of high yield now, we're going to go more into medium duration corporates and medium duration treasuries, and yet if you own a broadly diversified bond fund, that already may exist. You can argue about the difference between active and passive, but there's a reason why somebody might want to just own a broadly diversified bond fund, isn't there?
That's the premise of Bond Blocks, is that yes, it was really important for you to be able to own a broad diversified bond fund. It was really important to have access to that through the ETF and to make your allocations in fixed income so simple with ETFs. That was 20 years ago, and these markets are not the same markets they were 20 years ago. They're not the same markets they were 2 years ago. And so Bond Blocks has a products that allow you to see all the different areas of risk in fixed income to be more precise in that broad portfolio. If you build your portfolio with different components, you can put them on, you can take them off as you see fit. So that's one reason. And then the other thing is that that's for a certain type of investor that has a viewpoint and can implement it. There are most investors need help, and they need a fund that is broadly diversified and managed for these opportunities that are out there.
Yeah, well, let me pick up on that, Jerome. There have been very strong inflows into bond ETFs this year. I think 150 billion, including actively managed bond funds that you do. You've said before, active management in bonds does better than active management in equities. That's an interesting observation. Why do you believe active management in bonds can do better than active management in equities?
It comes from a variety of reasons, and you sort of hit on it a moment ago, which was the structural timing or the market timing element isn't really what's driving the returns in active fixed income. Rather, the composition of the indexes themselves lends itself to structural, perhaps, opportunities over this point in time. If you think about a fixed income universe, and specifically an index, maybe even the ag, it's one that has companies which are based on indebtedness. So the largest positions in that index are going to be the ones that have the highest amount of indebtedness. You may or may not want that exposure. And so as a result, the country segments, how issuers are coming to market in terms of investment grade, et cetera, those are opportunities which ultimately change the composition index. The ability to deviate from that in a rational way using research, using liquidity metrics, and frankly, just looking at what they value opportunities on an absolute and relative basis, that allows you to create opportunities in terms of excess returns to the benchmark rates. So the structural element there is fundamentally different from what you find in the active equity segment. Just leaning on one other thing here, Bob, you mentioned, obviously the flows that we've seen into this segment. From a macro perspective, the fixed income, the actively managed fixed income ETF segment is only about 15% of the total fixed income universe. But yet this year, the inflows are about $50 billion, representing 35% of the actively managed universe. Why is that? Because we're beginning to see that differentiation. rates are moving, credit spreads are moving, opportunities are changing. And as those incremental investors come to the marketplace looking for fixed income solutions, they're focusing on how to create and embrace that differentiation, recognizing the fact that they may not necessarily have the tools at their fingertips to do that, but realizing that market practitioners like PIMCO perhaps bring those opportunities in a different form in those fixed income ETF vehicles.
Before I let you go, I just want to get your thoughts on where you think bond yields might end up. The viewers, I know it's a scoreboard question, but 10-year yields at the end of the year, we're below 4% right now. Where do you think we might end up?
I think some of our research would say we'll end below 4%. So I wouldn't change anything.
So the trend is down, definitely.
Trend is down, yeah.
On yields. Jerome?
Yeah, we think there's a few things to calibrate here. Number one, what is the term premium in the market? Meaning, what does it ultimately mean to own longer dated securities, and what are you going to earn by owning those longer dated securities? So our view here at PIMCO is that the yield curve will gradually steepen over the next few quarters, and as a result, we probably want to be at the front of the yield curve. To answer your question more specifically in terms of the 10-year yield, we view it to be fair, right around 4%, give or take 25 basis points or so. But the front end is going to continue to reprice as the Fed continues to navigate what it views to be proper growth outlooks and obviously inflation outlooks over the next few quarters. That's going to be really the focal point of driving returns for many investors who are specifically focused on active management in the near term. So short end yields might fall in money market funds, but the total return potentials could increase across all actively managed segments of fixed income.
Okay, been a very interesting discussion. Two heavyweights in the ETF bond space, folks. We bring you the best people here on ETF Edge. And by the way, that does it for this week's ETF Edge. My thanks to Joanna and Jerome. We've asked Joanna to stick around for a few minutes to give us more perspective on bond ETFs for the rest of the year coming up on our ETF Edge podcast. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.